Okay, so thank you everyone for coming to join us tonight. So this is the second in a three-part lecture series. Hopefully many of you were able to see the first one. Either you were there or it's also available on our website. So for attending this presentation tonight, this presentation is really important to have the context for the third presentation, which will be in a couple of weeks from now. So you can also still get the first one along with a range of other presentations that we have available on our website. I'll post the link for that in the chat in a moment. We do a range of different workshops. Today we're doing a presentation on investment, but we also do presentations on financial planning. In fact, we have one next week on that. We do presentations on graduation topics, presentations on budgeting, credit, loans, and a range of other topics. We also have a Money Mentors program where you can either be a mentor or be a mentee. And it's a really nice way to learn about all these different topics in a more kind of social setting. If that's something you're interested in, you can also find that on our website. So for now, though, I'm going to pass it over to our presenter for the evening. We have Edmund Ryan, who is a CFA and a faculty member and professor here at Boston College. And tonight, we're going to learn a little bit about the basics of investment. So I'll pass it to you, Edmund.
Okay, yeah. How's everybody doing? Did you have a good St. Patrick's Day?
Yeah, it's pretty great.
Not like the old days, but hopefully everybody had a good day. We're going to try to monitor the chat, and Ari just sent a note, and so we're going to try to monitor it if something comes up. There are some complicated topics because investments is a very complicated subject. So this is meant to just give you a taste for what's going on. We have another session coming up. I think it's April 8th or April 5th. We're going to try to put it together. So by that time, at least you'll understand some of the terminology. If you want to follow up some more, I would suggest, if you haven't done this already, that you go to the library and get an online subscription to the Wall Street Journal. It's probably the best way to learn about economics and investments. And if you have any questions, by all means, speak up. We'll try to answer them. So we'll try to keep this to an hour. I just went over the material. I think we may run a little bit long, so feel free to leave whenever you have to leave. And usually when Ari and I do this session, we serve dinner, we serve pizzas, but we couldn't get everybody's address, so we couldn't have them all delivered. But look for a pizza in front of your dorm room tonight. If not, when we do this next year, stop in. You don't have to listen to the lecture, but you can get a piece of pizza. We owe you some pizza. Okay, fair enough? Ground rules, nod your heads. Okay. Okay, so we're going to talk about just basic concepts of return. When you talk about investments, you always talk about return, but you also need to understand a little bit about risk. We're going to talk about asset classes. I'm not sure if any of you are familiar with that terminology, but it's very common in discussions of assets. And we're going to talk about CDs, which you may be familiar with. You can get those at any bank, and money market instruments, which are really short-term borrowing by a company. We're going to talk about bonds, which is long-term borrowing by a company. And then we're going to get into the fun part, which is talking about stocks. Okay. So when you talk about investments, investing is all about two things. It's about the future. So you can't redo the past, you can't buy the past, and you may have heard the phrase that past performance is no indication of future results. It's very true. But investing is taking all the knowledge you have today and making a decision about what's going to happen in the future. Secondly, you need to understand a little bit about risk and return. So when you talk about investments, you talk about risk, which is the likelihood that you're going to achieve your investment objective. So just think for a second about different ways of looking at risk. Let's take an investment that will guarantee 10% a year, 10% return a year, versus another investment, which we expect it to return somewhere between 8 and 12% a year. So a little bit of a trade-off there. You can walk away from the guarantee and get 12%. You can walk away from the guarantee, you might get 8%. Let's make the question a little bit harder. So same guarantee now versus an alternative investment that can give you a return anywhere from 0% to 20%. Okay, so some people who are risk averse might say, okay, on that basis, I'm going to take the 10%. Other people will say, you mean I can really double my money over the period of time? And the answer to that is yes. Okay, I'm just looking at something in the chat. Okay, so just bear that in mind as we move forward on this. Okay, so when we talk about return, what are we talking about here? Right? So the return is you invest $1,000, how much do you make on it? And then what is the percentage of that? So in the example here, you invest $1,000 for a year. After a year, you sell that investment and you get $1,050. What is the return? Okay, it's what you sell it for less what you paid for it. So it's $1,050 less $1,000. So you had a $50 return on a $1,000 investment. So your return on investment is 5%. Okay, I want to. The alternative there is $1,000 invested for 2 years, and at the end of 2 years, you get $1,100. What is the return? The return over the 2-year period is 1,100 minus 1,000 is 100, divided by 1,000 is 10%. Now that's a 2-year return versus a 1-year return, but it's just to give you a concept of what return looks like. And no matter how complicated the investment, the formula for calculating your return on investment is what you get less what you paid divided by what you paid. So how do we get to where you're investing money? So the textbook would say first thing you need to do is understand how much money you have. So how much money is coming in? So your income versus your outgo. So you create a budget. You pay your bills. Which bills are required? Which ones are discretionary? So your rent is a required one. Going to the movies or is discretionary. How much is left? So you take what's left and create an emergency fund. And most people would say you need at least 3 months of expenses in your emergency fund. So what do you have left after all of that? It's really a short-term savings. So you can put it in a bank account, put it in your checking account. These days, the difference in return between a bank account and the checking account is pretty much zero. And you invest the rest. And if when you go to work, you're going to have an opportunity to put your money in a 401k plan. And you should do that as soon as you can, or you should put it in a mutual fund. So we'll talk about other types of investments as we go through this. So one of the fundamental concepts is compound interest. So Albert Einstein, the great physicist, stated one time, the most powerful force in the universe is atomic energy, and that's where he made his living, the sun, gravity, or compound interest. And I think to most people's surprise, the answer he came up with was compound interest. And I'll show you why. So if you invest $100 at 5% interest, okay, so every year you get 5%. Compound interest means you get interest on the original money you put in plus the interest you earn. So if you put $100 at 5%, at the end of year one, you'll have $105. In the second year, you're going to apply 5% interest to $105. And so if you do that, $100 at 5% over 5 years, over 25 years, you have $335. You do that through compound interest. So have to outperform. Well, there's a question here about investments outperforming inflation before considering returns as a profit. Generally, you look at the investment return without inflation. There is a concept called real rate of return, and it applies more often when you're dealing with bonds or things that pay a real interest rate. So if inflation is at 5% and you have an investment paying you 5% a year, your return is 5%, but your real rate of return, which is the actual return less inflation adjusted return, is 0. So there's two ways to look at it, but the most common way when you're evaluating investments is to look at it without taking into account inflation. So again, back to compound interest. So $100 at 5% for 25 years, you get $335. 50 years, okay, so you take $100 and put it in investment that pays you 5% for 50 years. You start at 20, at age 70, you take it out, you have $1,146. Okay, now what happens? Suppose you go out and you have an extraordinary life and you live over 100. Well, your $100 is now $13,150. I don't expect anybody here to live 250 years. So, but if you did, your $100 at 5% would pay you $19,830,000 at the end of 250 years. So it'd be a nice gift to your legacy. Now, if you did in fact come to this country with the Pilgrims and they went and invested $100 in the First Bank of Plymouth Rock and forgot about it, well, 500 years later, that $100 would be equal to $3.9 quadrillion. So that's more than all the gross domestic product of all the countries in the world with plenty to spare. So if you want to do a favor to your legacy, put $100 away and have them pass the bank book down every year. And maybe at the end of 500 years, somebody can have $3.9 quadrillion. All of that is because of compounding, because you're paying 5% interest on both the principal and the accumulated interest. It's a very important concept. When you put money in a bank, they pay compound interest. So it's already taken care of for you. So here's another way to look at compound interest. Simple interest is when you invest money and they pay you the interest every year, but it's not compounded. So in other words, you invest $1,000 and somebody sends you a check every 12 months for $100. So your return on investment, assuming you don't reinvest the money, your return on investment is $2,000. You get your $1,000 back plus 20 years at $100 a year. So your total return is $3,000. Pretty straightforward. Now let's look at over 20 years, same $1,000, but somebody is paying you 10% interest on the deposit and the interest that you earn. So your total return there is $7,100. So over a 20-year period, the difference between simple interest and compound interest, again, compound interest pays interest on the principal plus anything you've earned, is the difference between $7,100 and $3,000. So it's compound interest is absolutely remarkable. And again, if you put your money in a bank, you do. Let me see. I have some questions here. Okay. Keep going. This is an interesting thing. You can amaze your friends, but it's using compound interest. It tells you with reasonable level of precision how long it takes you to double your money. So if you have you take 72 and divide it by the rate of return. And if you do that, it'll tell you how long it takes to double your money. So the rule of 72. So if you have a 5% rate of return, you divide 72 by 5%, and you get 14.4 years to double your money. If you earn 12%, it takes 6 years to double your money. So there's a big difference between 5% and the other number. So and 12%. It's a difference between 14.4 years and 6 years. You can also, if you divide the principal by the number of years, it'll tell you, divide 72 by the number of years, it'll tell you what rate of return you need. So let's say you want to double your money in 5 years. Well, you divide 72 by 5 and you have 14 years. So it's just something you can do in your head. If you have a particular goal in mind, say, okay, it looks like I can do this, or it looks like I can't do this. It's a reasonability check more than anything else. So we're going to talk about different kinds of risk. And the first one is what we call a risk of default. So you loan someone $1,000 for 5 years, and they can't pay it back. So in other words, they've defaulted on the loan. So if they paid you some interest, you keep that, but you don't get your initial investment back. That's called default. We had a question earlier on inflation. So if investment pays you $1,000 a year for 10 years, how much is that $1,000 worth in 10 years? Well, we know what the actual amount is, but the real amount is you need to subtract the inflation rate from the interest rate. And that'll tell you what the buying power of that $1,000 is worth 10 years down the road. You can have a loss on investment. So it's not a default, but if you invest $1,000 in a stock and you need that money 2 years from now and you sell it and you can get $800 back. So you have a loss on investment. You might get $1,500 and you have a gain on investment. But the possibility of a loss is a type of risk. And then most people define another type of risk as volatility. So, and that's the probability of different returns. So you invest $1,000 and you don't know if you're going to get $900 or $1,000 or $1,200 back. So you have this volatility of return. And that the classic example is the stock market. Stock market goes up or down every day. And you can measure how much it goes up and down every day. And that will tell you how volatile the investment is. So here's just a timely chart that we have here. I put this together a couple of weeks ago. So Tesla, I think, has gone in the tank the last couple of weeks. And so we have two stocks here. We have Tesla and we have GameStop. And many of you may have heard about GameStop, how people put some money in GameStop and put $5,000 in there and became millionaires in a very short period of time because there was a lot of information, a lot of chatter on the internet. And when you create chatter, when you create demand for a stock, it drives the price up. So what all this chatter about GameStop did is it created chatter, which increased the demand. And you can see what happened here. GameStop, which is the light blue line on the bottom, just moved along without going up. The company was not doing particularly well, was losing money, and there were thoughts that the company was going to go bankrupt. And what GameStop was stores that sold video games. And most people don't buy video games from stores anymore. So look what happened to GameStop. Just follow the light blue line. It didn't go anywhere for a number of years, and then all of a sudden it popped. So it was down, I think, around $20, a little bit less. It went up close to $500, and it did that in a very, very short period of time. And then it came crashing down again. So you can see that spike and then the crash. So that's what we mean by volatility. Also what we mean by risk. So if you buy it, you could get more or less than you put in. If you bought GameStop at the peak, you would have lost your shirt. You would have gone from about $500. When I did this chart, it was about $40. So you would have lost, if you bought at peak, you lost about $450 a share.
Just to also add quickly about GameStop, the reason why the stock went up so quickly was because of buyers manipulating short selling. That's perhaps something beyond the realm of basics investment class, but I'll go see if I can find and put an article about that in the chat in case you're curious to read more about that.
Yeah, there were a number of reasons, and GameStop goes up or down. It's trading for more than the company is worth now. The other company is Tesla. So that's the darker blue line there, the top line, and that's Elon Musk's company. And you can see that that stock didn't really go anywhere until recently, until the last couple of years. And then all of a sudden it really took off. Now, Tesla as a company does not make a lot of money. They, matter of fact, they make most of their money from selling carbon credits, not selling cars. Now, remember we talked about investing is all about the future. Why are people willing to pay $700 a share for Tesla? Believe in Elon Musk, they believe in electric automobiles, and they believe that Tesla is going to be a leader in that market. So people are willing to bid up the price of Tesla stock, and you can see what happened to it. And I think Tesla has gone down over $100 from when I put this together. There's been a big hit in the tech market. So down below, if you invest $1,000 in Tesla 5 years ago, that $1,000 would be worth $17,000 today. Pretty good. $1,000 invested in GameStop would be worth $10,000. Still pretty good return. Pretty good return. I think it's a lot more confidence about the viability of Tesla than there is about GameStop. But it's just an interesting thing. We're going to spend a little more time later. Okay. So when you talk about investments, there are more things to invest in than stocks. And so what this wheel is, it breaks out the most common types of investments. And I come from a background of institutional investment. And for years, we used to focus on these three over here, which is a money market, which is primarily used by the government or by corporations to borrow money for short-term needs, primarily operating type issues where they have to pay some bills before the revenue from the sales comes in. So they borrow money in the money market. Bonds is another way for companies to raise money. And companies can raise money basically two ways. One is by issuing a bond, which is a promise to pay you, the investor, a specific rate of interest for a specific period of time. And at the end of that period of time, to refund your money. And a bond makes you a debtor of the corporation. And then the other way of a company can raise money is to sell shares, is it sell pieces of itself to investors. So when you buy a stock, you are buying a piece of ownership of a company. So today, some of the big companies might have 300 or 400 million shares outstanding. So if you buy one share, you are a 1/300 millionth owner of the stock, owner of that company. So you have short-term financing, intermediate or long-term financing by creating creditors of the company. And then the other way is a company can sell stock where they promise to give the stock investor a certain percentage of their earnings. So you own a piece of the company, for better or worse. You can buy stocks in companies that are more than just domestic companies, US companies. And so you have international equity. European companies, for example, have the same opportunities available to them. They use the money market, they use bonds to raise money, and they sell stock to raise money. And then there are other types of investments. Many people call them alternative investments. So you can invest in real estate. You can invest in commodities. So for example, you might want to buy gold. Well, that's a commodity. Or you can buy Bitcoin, which is a type of a commodity. So we're going to talk about a couple of those. For the novice investor, I think you really want to stay on the right-hand side here of this equation.
Really quickly, just because we're getting a lot of questions and thoughts about it in the chat, can you share, briefly your opinion on Bitcoin or cryptocurrencies?
Yeah, I wish I'd have bought it at $10,000. But what Bitcoin is there are no physical assets backing up Bitcoin. So what you do is you set up an account and you pay hard dollars for a Bitcoin. I think Bitcoin is around $60,000 for a Bitcoin now. And that coin goes into your account. I understand there's very, very stringent security around those accounts and the passwords. And so they're not of much value. They weren't of much value initially. They're becoming more valuable because some people will accept Bitcoin as payment. So a Bitcoin is not a coin. It's not a dollar. A Bitcoin is worth not what you paid for it. Bitcoin is worth what somebody else is willing to pay you for it. So Bitcoin goes up or down. It's gone up quite a bit recently. There have been periods of time when it was around 20,000, went back down around 7 or 8,000. And it's all a function of supply and demand. So I think we go into an inflationary period, then Bitcoin is probably a better place to be because your dollar becomes worth less, and theoretically Bitcoin would be worth more. So it is a commodity, but there is no physical commodity. It's just a trading commodity. It's not something you should do right away. So Cindy wants to know, what is the supply and demand of? What you're buying and selling is just the Bitcoin, what somebody else is willing to pay for that Bitcoin. Or in other words, somebody is willing to trade one Bitcoin for a new BMW. So it's worth what somebody will pay for it or what you can buy with it. There is no number on a Bitcoin that says this is a $10,000 Bitcoin or a $500 Bitcoin. There's only one denomination, and it's a Bitcoin. But I did see that somebody's going to start to have Bitcoin ATMs, and they'll start to roll out, becoming more popular. And as vendors become willing to accept it, and then I just heard about an NBA player who was making wants phenomenal amount of money. I think it was around $14 million a year, and he wants half his payment in Bitcoin. So he wants $7 million a year of Bitcoin. Dan Yang says, he's said he's a fan of Bitcoins and has done well, but he's saying don't put all your money in Bitcoin. I would suggest you don't put all your money in any one asset, no matter what it is. I'm not going to go through this, but if you have the slides and you can put them up, this is a pretty good, it's about a 10-minute video on stocks versus bonds, but I think I'll run too long if I show it to you. But I did want to make it available to you. And it's a lighthearted, I don't know if you've ever taken anything from Khan Academy. They do a good job explaining things like that, and they look at it in terms of financing a company. No, we're not going to do it. Okay, so we're going to talk about the three traditional asset classes, which is CDs, money market, sometimes it's called cash. And that is, again, really for short-term money that you need. And when I say a liquid asset, I don't mean your money gets wet. A liquid asset is an asset you can buy or sell very easily at a known number. So we'll show this video.
CDs are better than bonds. That's next. A certificate of deposit offers a higher interest rate than a money market fund or a bank savings account, but you don't have access to your money for a period of time without paying an early withdrawal fee. CDs offered by a bank or credit union are simple interest-only bonds that are sometimes very attractive. The highest paying CDs have higher yields than treasury bonds and give the small investor a rare advantage over conventional bonds and brokered CDs. For instance, today, the annual yield on a 5-year treasury note is about 1.5%. But in contrast, the yield for a CD with equivalent term and risk varies from a high of 3% to nearly 0. Wow, that's quite a range, isn't it? CDs are like bonds in that they provide fixed monthly payments, but cannot guarantee the full return of principal before the end of the term. The amount of the early withdrawal fee is limited, commonly 3 to 12 months of interest, depending on the bank or credit union. While that's generally true, look at this. This credit union offers an exception for CDs in IRA accounts if you are over some age. I don't mention this to advertise this credit union, but rather to emphasize the point that while bond market is incredibly efficient, CD market is not. And that creates some attractive opportunities for individual investors. Now it's time for some fun. I'll give you 2 facts. You choose the fact that's true. Here's one. Sometimes CDs are better investments than bonds. Here's the other. Large institutional investors invest in CDs. This is false. CDs are issued to individuals by banks or credit unions and insured by these federal agencies. So CDs, like US Treasury bonds, have essentially zero credit risk, but the FDIC or NCUA insurance levels are limited to amounts that make these CDs attractive to individuals, but inappropriate for large institutional investors. This is true. Keep in mind that bank CDs aren't negotiable, meaning you can't sell them in any market. To redeem them, you must go back to the bank or credit union where you purchased it. As I've showed, sometimes CDs are offered at above market interest rates with low early withdrawal fees. If you can lock in a CD with a higher rate than the equivalent treasury bond, then obviously you come out ahead for no additional credit risk. If interest rates go up, it can be even better, which I'll show you next with a simple example. Here you buy both a 4% CD and a 4% note. Towards the end of the first year, interest rates increase to 5%, and you'd like to replace them to take advantage of the new higher interest rates. To sell your CD, you'd have to pay an early withdrawal penalty, which we'll say is 3 months interest for our example. Our annual interest rate divided by 12 is the interest rate per month, which will multiply by 3 months to get the early withdrawal penalty. Note that it remains 1% of the amount of the CD for any day after that until the CD matures. But an ordinary bond is different. There is no early withdrawal penalty, but its price changes every time the interest rate changes. And the amount of the price change gets smaller as the bond approaches maturity, or more precisely, as the bond duration approaches 0. Now remember, we bought this bond 1 year ago, so there are now 4 years left on this bond. For now, we'll say that the duration is also equal to 4 years. A bond price always changes in the opposite direction as interest rates by an amount equal to the rate change times the duration. So our simple estimate is that the cost to refinance the bond is 4 times more than the CD, which is our point. Sometimes CDs are better than bonds. Again, you're not going to get rich with bonds, but bonds are.
Okay, so a little bit on CDs, and then he talks about bonds. So when we're talking about bonds, the Treasury, US Treasury issues a phenomenal amount of bonds, and also buys a phenomenal amount of bonds that they issue. But corporations issue bonds too, and they use it to finance their business. And here's a short video on bonds, just to give you a sense for them, because there's an important concept that he's going to cover here about what happens to a bond when interest rates move. And then we're going to spend a little more time on that.
Bonds are a common investment. However, to many investors, they remain a mystery. So let's explore what a bond is and how it might benefit your investment portfolio. A bond is simply a loan given to a company or government by an investor. By issuing a bond, a company or government borrows money from investors, who in return are paid interest on the money they've loaned. Companies and governments issue bonds frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have, while also generating additional income. Bonds are often viewed as a less risky alternative to stocks and are sometimes used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview agrees to pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now, let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview got the money it needed to build a stadium. The investor received regular interest payments and the return of the original investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a more predictable and stable form of investing. Compare regular payments of a bond to the experience of owning a stock. With stocks, profits and losses are driven by market forces and are generally less predictable. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults on paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk also come with higher coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically represent a greater risk of default, as companies can and do go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help bond investors to gauge the financial strength of the bond issuer. These ratings agencies often use different criteria for measuring risk. So it's a good idea to compare ratings when considering a particular bond. And keep in mind, rating agencies aren't always accurate. So be sure to research a bond and its risks thoroughly before investing. Another risk to consider is interest rate risk. This is the risk that interest rates will go up and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the new higher interest rate bonds. If you wanted to unload a low interest rate bond to take advantage of these new rates, you would have to sell your bond at a discount to make it a worthwhile purchase for another investor. Capital preservation and income generation are just two ways bonds might be part of a diversified portfolio. Many investors use a mix of stocks and bonds to pursue their investment goals. And because bonds move differently from stocks, they can help increase or protect portfolio returns. Keep in mind that this discussion showed you one simplified way that investors might use bonds, and only a few of the risks to consider. Like all investments, bonds are complex and have a variety of uses and risks. Before you invest in bonds, it's important that you invest in your own financial education.
Okay, so we talked about cash, and again, that's short-term financing by a company or a bank. And we talked about bonds, which is longer-term financing where the company is borrowing money from you for a period of time. We have a question here on dividend yields come into account when looking for stocks, and the answer to that is absolutely. But the dividend yields are not consistent across companies. So if you have a dividend is a way of distributing the earnings of a company to its owners. And remember, as a stockholder, you are entitled to the earnings. Now, you can do two things with them. A company can do two things. One is to pay them out to the owners, and that's called a dividend. And the other is to take the money and reinvest it on the hope of earning, increasing the value of the company even more. So startup companies generally don't pay dividends. Growth companies like a Tesla generally or rarely pay dividends or they pay minimal dividends because people invest in Tesla because they want them to invest everything they can into the company. So when you pay out earnings, it's less money for the company to invest. There are stocks that traditionally pay higher dividends. So for example, a utility company or a slower growth company would pay out a higher percentage of its earnings to its investors in the form of a dividend than a growth company. So, but when you calculate the total return for that particular investment, you look at the appreciation in the stock and you add in any dividends you might have received. So I've got about 30 to 40% of the overall return of the stock market is based on dividends. Dividend paying stocks tend to be less volatile than companies that don't pay dividends. there is a rotation going on in the market now. Rotation means investors are moving out of particular types of securities and moving into another type. They're moving out of tech shares. So I looked at the NASDAQ, which is really the tech companies exchange, and that market has been hammered recently. Last time I looked, tech shares were up about 4% year to date. But dividend companies, more conservative companies, consumer product companies, a Walmart or something like that, they're up about 13%. Prior years, that has been reversed, where the tech companies grew like crazy. Things have a way of balancing out over time. SPACs. Let me hold that. That's a much more complicated discussion right now. Okay, so bond basics, and here's the key point here on bonds, and they mentioned it in the video. It's debt issued by a company, units of $1,000, and they pay interest annually or semi-annually. So when I say a company, it also applies to the U.S. Treasury. So if you buy a Treasury bond, you're going to get interest semi-annually, and at the end, at maturity, 10 years, 5 years, 3 years, 3 months, you're going to get the repayment of principal of payment of $1,000. So you can sell bonds. You can sell pretty much anything, and the price of that bond varies based on the interest rates on alternative bonds. So, for example, IBM issues a 6% bond with a 15% or 15-year maturity in 2015. So in other words, if you bought that bond, you would get a payment of $60 a year until 2015. At the end of 2015, they would give you $60 plus your original $1,000 back. So that's an investment where you're going to get $60 a year. What happens if IBM issues a bond that pays 4%? Interest rates went down. And so instead of $60 a year, you have an investment that pays you $40 a year. And at the end of the period you're holding the bond, at the end of 10 years, 2019, they're going to give you $40 interest and $1,000 principal repayment. So if I go to sell, if I need some money and I go to sell my 6% bond, paying me an investment paying me $60 a year, and in an environment where bond investors are only getting $40 a year, then it stands to reason that my $1,000 bond in the marketplace is worth more than $1,000. It's worth more than the 4% bond, because you're getting more money. You're getting a higher return on investment. You're getting $60 a year versus $40 a year. So the bond, when I sell it, will give me a higher number, and bond yields tend to equalize. This is a fairly complex topic, but you need to understand that the $1,000 is locked in. Everybody gets $1,000 if you hold the bond to maturity. But if you sell it prior to maturity, the amount of money you get for the sale of that bond can be more or less than $1,000. It's more if the interest rate you're receiving is higher than current rates, and it's less if the interest rate you're receiving is less than current rate. So if interest rates are at 6% and you have a 4% bond, your 4% bond is worth less. is a theoretical question on direction of the market and is the Treasury, what are they doing? Monetary, they're talking about, there's a lot of talk in the investment market today about inflation. And the reason why there's a lot of talk about inflation is because there's a lot of money finding its way into the economy. So there's right now an excess of money. There's more money available to spend than there are things to spend it on. So when you have more money available, then you have commodities available, that moves the price of the commodity up. And you can see that if you go to buy gasoline. If you go buy a tank of gas, it's probably up 50 cents a gallon. There's a lot of talk about inflation coming in. There are people that say, don't worry about it. There are other people that say this is a big deal. The head of the Fed, Jerome Powell, says we've got the tools to control inflation. And there are other people that say maybe you don't have the fuel. And what is happening in the market, the interest rate market, is over the past few months, interest rates on a 10-year maturity government bond have gone from below 1% to about 1.6%. So the cost of borrowing money has gone up. So that also leads to inflation. So as costs go up, there's inflation. And I think if you have an excess of money, then that could cause inflation. So they need to be careful with all this money they're pumping out into the economy. If the other side of it, the other side of the equation, if we don't become more productive, then you're going to have inflation. In the 1980s, inflation rates in this country were in excess of 10%. I had in the 1980s, I think it was a 12% mortgage. So today I can buy a house and get a 3.25% mortgage. Big difference. Interest rates change daily. Okay, so because interest rates change daily, then the value of the bonds changes daily. So, and you can see where we started. I only went back to 2000 on this, but 2000 interest rates were around 5%. This is on the 10-year Treasury. They got as low as 0.7, 0.8%. And they're now, I think they just crossed 1.6%. So a fairly rapid run up in interest rates. Increases borrowing costs to everybody, including the government. So, and again, a 5% bond in a 2% market. So if you bought a bond in 2007 paying 5% and you sold it today, you would get more than $1,000. If I had a 0.5% bond in a 1.5% market, so again, rates do go down to a 0.5%. Interest rates today are 1.6, 1.5 when I wrote this, then I'm going to get less money if I go to sell that bond. Okay, I've got about 15 minutes, so I'm going to show you some of this on stocks.
Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments, stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments, such as bonds or CDs. However, investors keep coming back to the stock market. Why? Because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks, but that's just the beginning. Open an account with TD Ameritrade for access to more award-winning.
Okay, so that is about as basic as you can get around stocks. So you looked at the three primary asset classes. We looked at cash, money market, CDs. We looked at bonds, which are corporations borrowing money from investors. And we looked at stocks. So here is just an example of three stocks. And this change here is it's percent, because we're comparing, it's the percent growth in each of these stocks. So we have Microsoft, which is selling today for about $232. Tesla was $680. So I think on the earlier chart I did, it was over 700. And Intel is $60. So it just goes to show you, and because of Tesla having such high performance, it's kind of a funny shaped graph. But you can see Intel is the purple line. And over that period of time, over the 10-year period, Intel has gone up 110%, roughly doubling in that period of time. Okay, if you look at Microsoft, which is the darker blue line, its return is more than doubled the return on Intel. So two different companies, two different rates of return. Microsoft at times becomes the most valuable company in the world. That bounces between Amazon and Microsoft and Apple. And then lastly, you have our friend Tesla, and you can see the return again. If you put money in Tesla, you can see how much the return, how much greater the return is. And Microsoft, by all means, is a good growth, a fast growth company. They're a smart company. And you can see that Tesla, people believe more and they're willing to pay more for Tesla for the future than they do in Microsoft. And they're willing to pay more for Microsoft than Intel. Yeah, there's a comment there about Intel. I think that company is in trouble. And I happen to own some Intel. I've owned them for 30 years. Also own Microsoft and then for 30 years and did quite well. I bought them both at the same day, on the same day. And Microsoft is, the value is 20, 30 times what Intel is. So they're having a lot of trouble. They're having a lot of quality problems. They missed the market. So companies like NVIDIA got in on the games and Qualcomm on phones, and they were building microprocessors for PC. Okay, so what do you look at when you're looking at a company? Okay, there's really three questions that you need to answer. One, are they growing? So how do you know if a company is growing is you look at its revenue, the amount of sales that it has, and are they in a good position to keep growing their revenue? Are they making money? What is their profit? And can they increase their profit? Because you, as an investor, as an owner of the company, want your company to make money. Are they in a position to continue making money? And by owning that stock, are they providing a sufficient return to the investor, you being the investor? So whenever you evaluate a company, you look at three things. Are they growing? Are they making money? Are they providing a sufficient return? And then you can use that as the basis for the future. Because when you buy a stock, you're buying the future of that company. So let's look at two companies, similar, roughly similar kinds of business. You have Amazon and Walmart. So in 2010, Amazon had $34 billion in revenue, and Walmart had $400 billion in revenue. 10 years later, Amazon had $386 billion in revenue, and Walmart had 548, still about 50% bigger in terms of revenue than Amazon. Walmart, a good job, increased they're growing by 30%. Amazon, over that period of time, their revenue grew by 1,000%. Okay, so are they growing? Are they making money? Well, 2010, Amazon made $1.5 million, so basically nothing. In 2020, they made it's 1.5 billion. They made $25 billion. So their profit went up 1,586% growth versus Walmart went from 25 billion to 29 billion. Over that period of time, only 16% growth. So what about the stock price? And that's what the chart shows you on the right. The stock price went on Amazon from 123 to 3,000. It's a 2,300% increase in stock price. Walmart went from 54 to 144. Still pretty good growth. But compared to Amazon, looking at two retailers, look at the difference. And then the value of the company. How much would it cost you to buy every share of stock in the company? Well, Amazon went from a value of 81 billion to 1.6 trillion dollars. And Walmart went from 192 billion to 407 billion dollars. So you can see that's reflected in the stock price. So are they growing? Are they making money? And Amazon's been a darling of the investors, and you can see what happened to the stock price. So their investors are looking for growth, and they need to have confidence you're going to grow in the future. Question here on dollar cost averaging. I think that is the way to get into the market. I don't think people should time the market. So if you have money to invest in the stock market, I would not invest all of that money on the same day because the market goes up and down. So you need to take advantage of the dips. When you're in a 401k plan, you are dollar cost averaging. So your money is going in every paycheck. That is the best way to invest in the market. Consistent dollar amount over time. And when you look at it, your average cost per share will be lower doing it that way. That's the lowest way to do it. Also, when you're investing in the market, you need some level of diversification. So buy more than one stock, buy more than one security, buy more than one type of asset. And we'll look at historical returns because stock markets have provided very, very high rates of return, which is the dark blue line. You can see it, but there's a lot of volatility. So we're going back to 1979 and look at what's happening to the stock market. And look at what happened recently to the stock market. And then how about bonds? Now, remember, you're marking bonds to market every year. So if interest rates go up, the value of the bond goes down. You see, bonds provide a lower return than stocks, but they're less volatile. The ups and downs aren't as pronounced as stocks. And then you have the treasury bills, which is short-term investment. There's minimal volatility, but you can see that interest rates went down from roughly 10% down to where they are today. And then over time, you just show you different growth of investments over a period of time. Stocks historically outperform bonds by 3 or 4%. Bonds historically outperform money market by several percent, 2-3%. That's not the case today, but historically, that's where they've been. So how do you decide? You look at your age, your risk tolerance, your cash needs, your investment horizon, other assets. So question on ETFs. ETFs are exchange traded funds, and there's literally thousands of different types of ETFs out there. They're very similar to mutual funds. There are some technical differences and some legal differences, but what they do is they combine investors' money to buy portfolios of different types of stocks. So, or some of them are fairly focused, some of them have a wide variety. So for example, you can buy a mutual fund or you could buy an ETF that only focuses on technology companies. You could buy an ETF that only focuses on energy companies. You can buy an ETF or mutual fund that focuses only on small companies. you can buy an ETF that invests in government bonds. So an investor starting out, you should invest in a pooled fund, an ETF or mutual fund. When you go into a 401k plan, your investment choices will be mutual funds. So you want to invest in a mutual fund and you want to stagger the money going in your dollar cost average. That's the best way to get in. So that's about it. We're going to talk a little bit about constructing a portfolio in 3 weeks. Hope you got something out of it. Question, are Vanguard the best ETFs? Vanguard prides itself on being the low-cost provider. So they are a very good company to do business with. Fidelity is a good company too. But Vanguard provides excellent service at probably the lowest price out there.
So we have just a few minutes left. So let's see if we can maybe answer 1 or 2 more questions and we'll wrap up in maybe 2 or 3 minutes.
Okay. Vanguard or TD Ameritrade for investing. The cost of any of these platforms now has been driven down to pretty much zero. So they used to have $5 to do a trade. Most of these platforms today are trading at zero. TD Ameritrade, I think, just brought Charlie Schwab. So both of them give you good technical information. Both of them give you good systems to work with. I guess I'm indifferent to them. I know I have a lot of friends use Vanguard. I use TD Ameritrade. But either one is a good one.
We'll have Sarah's question be the last question for tonight.
This could get any advice on managing investments and tax implications. So if you today, if you hold an investment, you spend $10,000 on it, and that investment goes up to $20,000, you don't pay a tax on unrealized gains. And unrealized gains mean you didn't put the gain in your pocket. If you decide to sell a $10,000 investment for $20,000, then the difference between what you paid and what you got, the $10,000, becomes taxable to you as a capital gain. And the tax rate you pay depends on how long you held the asset. So shorter term assets tend to have a higher rate. There is talk out there of bringing up the tax on capital gains to as high as 40%. That would have significant impact on investments. And if it goes to 40%, people will sell their stocks at a 20% before the 40% takes effect. So you have to, there's a lot of talk on changing tax, so you have to be very cognizant of what's going on. But again, at least at this point, they're not taxing you on unrealized gains. Elizabeth Warren has a wealth tax, which she has been a proponent of, and it would affect high asset individuals. And they are going to calculate the wealth, they're going to include unrealized gains. So if you had a $10,000 stock, it's now worth $20,000. That would be included in your wealth, even if you didn't sell the stock. So there's a lot going on, and I think it's going to be a very complicated year from a tax standpoint. But you always need to look at the tax impact when you buy or sell a stock. In a 401k plan, there is no capital gains tax on selling and buying, as long as the money stays in the plan. So if you don't take the money out of the plan, you don't pay a tax on it. One of the big benefits of it. So it's been a pleasure. We had a good crowd. I know we ran a little bit long, but again, hopefully you got something out of it. And Ari will post the tape and you go back and look at the videos again.
Yep, we'll have this on our webpage. And just to remind everyone, we have a presentation next week on financial planning, a good follow-up to our talk today. And we'll have the third part of this presentation in early April. So please try to check out both of those as well. We'll send out emails when those are coming up. So thank you, everyone, for coming tonight. And I hope you have a good rest of your evening.